Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in and watching each and every week. This week is no exception. We're carried on 5 radio stations in 3 different states from Albuquerque, New Mexico, and love those people down there. I just can't seem to crack into getting a great real estate agent to come on the show and help us with describing what's going on in the real estate market down there. I read it from afar, but there's nothing like boots on the ground, as everyone knows. In Las Vegas, Nevada, those are great people out there too, and we are on AM 1400 out there. Love Las Vegas, been out there since 2004. We're in the Inland Empire in Southern California, San Bernardino and Riverside, all up and down the 15 and certainly parts of the 10. I want to say hi to all those fine people as well up in Lake Tahoe and the people up there. We have real estate agents and loan officers, and I say we, I mean Malibu Funding. They're the sponsor for the show, and really appreciate their help in putting on this show now for almost 6 years. Their NMLS, of course, is 79620, and they're in about 10, 11 states, soon to be up in Idaho as well as in Minnesota. Don't ask me why those states have been chosen. I don't make those decisions, but they seem like fine places, and even though they're in and out of the news for all the wrong reasons, I think they're great markets, and certainly we like to serve as many people as we can. In the news this week, there are a number of different things. We're kind of waiting on what's going on with Tesla. I'm enamored with the company. I'm enamored with what they do in the battery technology world. Touching on parts of what we have to do for solar power in California as well as the rest of the nation. Certainly out west, solar is the way to go. It's cheap in terms of producing the energy. The upfront costs are significant, there's no question. But if we can factor in the value it has for both the environment and you as a customer, bringing the cost of electricity down during the summer months, and usually about 6 months of the year, the solar generation on our end really pays for 85% of the year in terms of what we need to spend on electricity. So for us, it's a great idea. And I say anybody out west, out east and the northeast, you just don't get this high-powered sun, but they use other forms of environmentally sound technologies to be able to generate electricity. All these are great things. One of the things about solar, and I've just experienced it once again, is in many cases, people have installed solar on their homes and they've financed it. So if you, let's say you sell your home with a financed solar project ongoing, or you are own it outright, but you still have the payments to the solar company. You want to sell it or you want to refinance it. You have to get what they call a subordination agreement, i.e. the people who you owe money to on that solar system are willing to say, all right, we'll go into second position and we'll allow the first mortgage or the mortgage on the property to go in first position. What does that mean? It means that let's say you get into trouble, you can't pay anymore, who gets paid first? That's what that means. So the first position usually goes to the largest amount owed, and usually that's a first mortgage. In this particular case, it's a big number, no question about it, but we had to get a subordination agreement. And since Malibu Funding is the lender, and I happen to work for Malibu Funding, the sponsor of the show, really appreciate them doing that each and every week for years, we had to sign a subordination agreement saying that the solar panel people would come in second position. Now, Malibu Funding as the lender. So think about this for a second. If you have solar, if you have the ability to pay it off, it's better for you. If you don't have the ability to pay it off, this subordination agreement has got to happen on a refi or a purchase. That's really the nuts and bolts of what's going on in solar. I love solar. As I said, the Tesla battery technology that is probably out already, but we're still at taping time trying to figure out what kind of technology it's going to be. Now we know it's going to have to do with the extent or the life of the battery, right? They're calling it a 1,000,000-mile battery. We talked about it previously on the show. Also, the costs, i.e. the scalability of the new technology in order to reach as many people as possible, deliverability, when and how fast we can get it to. In my own case, at my house, we bought solar years ago. We just installed a couple of batteries. These batteries are what they call the Tesla wall. Now, it's let's say it's 5 inches wide, about 4 feet high, and it's six inches deep. A very small thing. We bought one in order to store power in case we lost power. And in our area, as well as many areas in Southern California, Northern California too, and many other states, high winds, they shut down the grid. And that is because they want to prevent fires, right? And as we all know, fires are ravaging what is happening in the West, all over, from Seattle down to New Mexico. We're just burning all the time. So when that happens, if you have one of these batteries, you are able to continue living. You can, for AC, whatever else happens. That's a good thing. So we too, we bought this battery. So as I said, for us, the system is tremendous, and it's a tremendous asset for us when we sell the house. Why? Because we don't owe anything on it. We got great rebates, and as a result of that, and having the best technology available on the market because of the batteries, we're generating all our own power. We could live off the grid right now, and it's an automatic switch. If the power grid goes down, our batteries kick in. So it's a tremendous asset for us as a family. Okay, so solar aside, there are a bunch of other stuff that we just want to quickly get to. We talked about the Paycheck Protection Program last week. Now, that helped a lot of small businesses. And when I talk about a lot of this stuff, it's augmenting what happens in the real estate and mortgage world. Mortgage rates are flat and basically not moving up or down. Why? Because the Fed is buying as many mortgage-backed securities and treasuries as they can. And that is artificially keeping the rates very low, because you're not going to have to up the demand, i.e. the yield. Yield means you are going to pay anybody who buys a bond more this week than you did last week if the demand is low, right? It's a supply and demand thing. Well, if the treasuries are buying all of these bonds just because they say they're going to, it really holds the demand down. So therefore, regardless of what the yield is, the treasury is going to buy them. So why sell them at a higher yield? It doesn't make any sense. There are people who are out there besides the treasury buying bonds, but usually it's a safe haven for them. It's usually, okay, in the market that I'm in, whatever I'm buying and selling in order to maintain or make money is in danger. So it's always a flight to treasuries, right? So they're in a range of like 0.57 up to 0.72, within that range. And as a result of that, rates are basically flat. So let's get quickly to the rates just so that you have a notion as to what I'm talking about. 30 years at 3.05, the 15 is at 2.68, FHA is at 2.50, and jumbo is at 3.40. Let's see, there's a bunch of other stuff, a lot of lists and that to get to. Paycheck Protection Program is interesting because they've, okay, here we're up against the clock right now. We'll be right back. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening each and every week. We're on a number of different podcasts, the Big Eight as they call them. If you want to see us and hear us, you can go to YouTube, Jeff Barton, the Mortgage Voice. And we're a couple of radio stations that we're on, carry video feeds as well. We're on 5 stations in 3 different states, from Las Vegas down to Albuquerque, New Mexico, as well as the Inland Empire, San Bernardino, Riverside, and up in Central California in Tahoe area. With us today, once again, is a great person, both as a knowledgeable account executive, but also somebody who really watches the market. She's been in Southern California, I guess. April, how long have you been in Southern California?
How long have I been where, Jeff?
Here in Southern California.
Goodness, since 1980.
Oh my gosh. Well, anyway, it's April Lopez from Nations Direct. And April, thank you very much for coming on the show.
Thanks for having me, Jeff. How are you today?
You know, I'm actually a little anxious and I'm not quite sure why. Maybe it's just the general feeling of, I don't know, not knowing, uncertainty, a lot of those things. I mean, we try to rely upon what we know and what we do each and every day. And some days are better than others, especially now. How are you?
You know, I'm doing good. I couldn't agree with you more. I think that, it's been a challenging 2020, and I think everyone's trying to get an idea or just feel comfortable as to what's going to follow. And, the good news is that the housing is driving our economy still amongst this during this unprecedented time. So the rates are staying low. And I think the risk factor, however, is still high because the lenders aren't too sure, what's going to happen. So there's still a lot of risk that's in the air.
Okay, let's assess risk. When your company, Nations Direct, looks at a loan, how are they assessing risk differently today than they would have been, say, a year ago?
So as of today, based on the new COVID-19 guidelines, the big agencies, Fannie and Freddie, we're trying to look at the overall picture, and the most important thing is the borrower's income, right?
Right.
So with everything shutting down, the new guidelines that have been put in place are really strict. Wage earners who happen to be furloughed for a certain amount of time, 3 to 4 weeks, a month, we're still going to be averaging their income over the whole year. And Fannie and Freddie has said we are not going to remove that time off due to these unprecedented times because we really need to know what your current income is, right, and what your income has been this year. So that's for a wage earner, a borrower who's paid W-2 pay stubs.
Right.
For a self-employed borrower, the risk is greater, and, we can't really determine because we don't have an employer paying them a paycheck. So the new COVID guidelines for a self-employed borrower is that, A, we want to see 2 months of business bank statements. Now, if they're Schedule C, they can provide personal bank statements, and we want to see that the income that they filed in the year 2018, that their income, because most of them haven't filed 2019 taxes, that their income is sustaining and that they're actually working and producing income. And we want to also see invoices show within the last, say, 10 days of the note date that they are actively employed.
Okay, so and then how do you determine that if they're not getting a paycheck with a self-employed borrower? Now, I know this is tricky because we get complaints from borrowers who say, hey, they keep calling every other day, which I understand. But how are you, I guess, looking at it, not only from a risk standpoint, from a logistical standpoint? How often, when do you call? What are the questions they ask? Is it written? Walk us through that a little bit, please.
So what we're doing is we're looking at their bank statement. So, for instance, for the month of August, they provide us a bank statement, and we look at their deposits. As a self-employed borrower who has a business account, and we see that they have deposits that are running through their bank statement, and that total deposit for the month is somewhere around what they possibly have been claiming in their prior tax returns. And then we ask because for a verbal verification of employment, like you said, we usually call the client or the business, but if they're not operating, then we ask for an invoice. So, for instance, believe it or not, a gardener, they have generic invoices, and they sometimes get paid cash. So we just ask them to provide us invoices within 10 days to show that they were at 123 Main Street and provided, an invoice to that homeowner for services rendered.
Tell me some of the programs that you are seeing as popular. Is it just your straight conventional FHA and 15 or 30 year? What are you selling out there in the marketplace, or what are you seeing borrowers gravitate to at Nations?
Well, we're still seeing a lot of just regular conventional business. About 57% of the business right now believe it or not, are still purchase loans. So we have a
Wow.
ton of buyers that still want to buy, and they are having a hard time with inventory, but they're doing
Right.
traditional 5-10% down conventional loans.
Okay. And I know you're in the real estate market in terms of knowledge and watching it because it directly affects what you do in the loan business. The inventory itself, it's on just a 10-year low cycle. Do you think sellers are holding back, don't want people in their homes, or you just think there's just not enough homes to sell?
There's just not enough homes to sell. I think they finally, after about June or July, got over the COVID risk, because there were sellers who still lived in their homes and they were worried. But now there's just not enough homes, Jeff. I mean, I am seeing, with my spouse being in the real estate business as well, a $500,000 home he put on the market over Labor Day, and he got 28 offers over list price. And these buyers were walking in the door discouraged because they were telling him that they were putting $20,000, $30,000 over list offers and still getting beat out.
Well, that's unbelievable. And okay, so the profile of the buyer that's getting disappointed, who are these people? Are they millennials? Are they just Gen Xers? What's the age? What's the makeup of?
They're actually the young families. They're young families that walk in the door. They have one or two children. All of them, still millennials, but and they are looking at like their profile. They're all trying to be 5% down. None of them really have more down payments than that. We saw a lot of VA clients come through, and the unfortunate part is then you have the question: well, if they're paying over price, what is it going to appraise for? Yep. Right?
And how have the appraisals been affected?
Do they have the extra money to bridge the gap of the sales price to the appraised value?
Well, so if you have a seller that's thinking, okay, I can price my property X amount over the last sale in the area, and the appraisers themselves are looking at comps, and they're having difficulty as buyers coming up with down payment, this doesn't sound like a successful formula unless you have a big down payment.
That's correct. And that's what, as a real estate agent, you have to look at the whole profile. If you're representing the seller and you've got 28 offers, who is going to be the one that's going to be most likely to be able to give you over ask, plus understand that, yes, since inventory is low, you're going to pay a premium and have that extra money to bridge the gap.
Right. And then from a lending standpoint, the reserves that you must have, the proof that you can pay X amount of dollars in taxes and insurance, that's all got to be considered too. So this is not simple. Obviously, if you have cash in the bank or you have family members who can gift something to you, that's obviously positive, yes?
Correct. Mm-hmm.
Right. Okay. Hey, April, I appreciate you coming on the show once again, giving us your expertise in the marketplace as well as for loans over at Nations Direct. You want to give people a chance to get a hold of you in case they need either real estate or mortgage advice?
Absolutely. April Lopez and Nations Direct, 818-398-1272.
Excellent. Thank you very much. And I really appreciate you coming back on the show once again. You're our best guest. Thank you.
Thank you, Jeff. Have a great day.
And you too. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. And thanks very much each and every week. You can hear us on our podcast. And that's, what are the big 8 there, Carl? List of them? He's busy right now, so he can't see it. But it's iHeartRadio. It's Spreaker. It's on YouTube as well. If you go to YouTube, Jeff Barton, the Mortgage Voice, you can hear and see what we do here. 5 different stations, 3 different states. And a couple of those states that we're trying to get to, we're also expanding in our radio market. So thanks very much for tuning in, listening to what we do, and also bringing you the information you're going to need. Look, if you're out there trying to get a mortgage right now, and you're trying to buy some real estate, I know how hard it is. I have a lot of clients, family, friends, who are trying to do just that. So I'm very well aware of what's going on. In the reverse mortgage field, there's no one better than this next guest that I'm bringing on. She'll tell us a little bit about what reverse is again, and then explain to us some of the advantages of the programs that they're offering now. Is Nina Penny, and she works in Arizona, and work nationally, or at least in the 10 states, Malibu Funding, the company that she works for, and I work for. Nina, how are you today?
I'm doing great, Jeff. How you been?
No, I'm a little, as I was saying earlier to a guest, I'm a little discombobbled. I don't know what it is. Maybe it's the time, the day. Maybe it's just that my skin is crawling. I have no idea. The uncertainty of our situation, sometimes it gets to me. I don't know. Does it get to you sometimes?
It sure does. It sure does. It every day. It's like Groundhog Day, because you never get to do anything different. I
know, I'm selling a home, so that's a little bit different. Usually, I just kind of run the company and do the video as well as radio shows. Try to enhance what we do for customers. Let's talk a little bit about reverse mortgage. Tell us something about reverse mortgage that we may not know.
That they're not the product that most people believe in. That a lot of the facts that people think the bank owns the home and the bank is going to throw your parents out, and the fact that they co-own the house and they take title. All those are misconceptions back, going back as far as the 60s. So, in the 80s, when Ronald Reagan was president, he actually changed the whole program. And we still struggle with clients to educate them on how the program really works.
Well, now, I know we've talked about it many times. We've had a couple of specials on it. I really like the program, especially for somebody who is income challenged later in life. Tell us about the income qualifications, what are the age limits, something like that.
So one of the borrowers have to be 62. So let's say my husband is 66 and I'm, 60. We can still get a reverse mortgage as long as one of us are 62. The numbers will be based on my age. And that's pretty much because, on the number sense, I'm expected to live longer than he is. So the numbers will be based on me. And then in qualified, we really don't look at credit so much, credit scores. What we really look at is when we get done, looking at your monthly income and backing out, any credit card installment loans, looking at what your taxes, insurance would be running on a monthly basis. As long as you have, for one person, $590 left over, or if a household of two, $995 left over. So, qualifying is very different than traditional loans.
And the reason for that, obviously, is that you're retired, your income is limited, and making sure that people can stay in their home, I guess, is the primary. What happens when, if one of the persons on the loan passes away? What happens to the other person in the house? And
they get to stay. They get to live in the house because we've estimated the numbers on, the youngest person. So when the last of the two people leave the home, either by death or they sell the home, the loan becomes due.
I see. And my understanding is that there is some time that if there is, both parties are deceased, that the living relatives get to decide what to do with the property, and they might have a little bit of time to figure out if they can refinance it or if they have to sell. What are the time limits with that?
So the original time limit, let's say, my husband and I both pass, and the kids, the first thing that people should do is reach out to the lender and let them know. It's no secret because the moment that you pass, the lender finds out right away through Social Security. Right. But it's a good thing to reach out to them and just let them know, we're not sure yet what we're doing. And, the bank gives normally on the first go around 6 months. If you need more time, basically as long as you keep the bank in in touch, and in the loop, you really won't run into problems. It's when you try renting the house out,
Right.
or you try living there and think nobody knows. That's when trouble starts.
I see. So this program is really designed for obviously older people who are income, I guess, they have a challenge with the income and they're trying to keep up with the bills and the mortgage payment. How often do these things get to foreclosure? Obviously, if both parents die and nobody's paying the rent, it's going to go to foreclosure. It rarely does, if ever, when either one or both are living, correct?
Well, the house, while the two folks are living, they never have to make any payments on the loan.
Right.
Because all you need to do is pay their taxes and insurance on time. And then when the last person leaves the home, it really depends. I mean, if the heirs reach out to the bank and they work with the bank, and they're trying to sell it, it's not going to go into foreclosure. I mean, the bank does not want to go into foreclosure, if you can imagine. It's just not really what they want to do.
Right. Of course not. I think
They'd much rather sell it.
Yeah, the way I explained it is, the reverse is a lot like a forward mortgage or a regular mortgage, a conventional mortgage. The only difference is that you don't have to pay it back. And you don't have to pay it back on a monthly payment. And that is really
Now,
straight.
Exact, Jeff. A reverse mortgage is simply an FHA loan that you're not obligated to make payments on. You can if you want, but you're not obligated to do so.
Now, some of the people who are moving down into Arizona, selling their properties in other states, moving down there with equity or money in their pocket. Explain to us a little bit about the reverse purchase and how that might work for someone who's like that.
Well, what we're finding right now, a lot of people in California, have had enough. So they want to leave. And a lot of people I find want to come to Prescott, Arizona, where, or someplace where, they have great weather and taxes are better. And they may sell their home in California and they might have, $500,000 or $600,000 cash. And with a reverse mortgage, using it as a purchase, you only have to contribute approximately 50% of the sale price, and it gives you the benefits of really owning the home with no payments. You can if you want, just paying taxes and insurance. It's a great, great program, and I do a lot of them because you can imagine, keeping some cash liquid and being able to live in a home with the same benefits as paying cash is very, very attractive.
Exactly, especially, Prescott's beautiful for one. Two, you could probably buy more for the money there than you can in Southern California. And, like you say, having a bunch of cash in the bank, making no payments on your mortgage, that's very attractive to someone who's retiring or retired.
Absolutely. And, we find a lot of people that leave California go to Prescott, or maybe they go to Nevada. These states, Jeff, I know you're licensed in Nevada, and we do business here in Arizona, and everyone that's leaving California that's listening to this should really look at a reverse mortgage.
I agree.
Learn about it.
Hey, Nina, we're up against the clock here. I really appreciate you coming on again and explaining the benefits of not only the reverse mortgage, but of what you do and how you take care of your clients. Thank you very much for coming on the show again.
Thanks, Jeff. You have a great day.
You have a great day, too. That's Nina Penny from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. For listening to us on podcasts, we have 8 different podcasts that we're on. They're called the Big 8, and also on YouTube, Jeff Barton, the Mortgage Voice. A bunch of radio stations from Albuquerque up to Las Vegas through Southern California and Tahoe. Anytime you listen to us in any of these formats, just click that you like us or you want some more information. Why? Because it helps us reach more people. We'd really like to build the show into a national powerhouse, and your help is greatly appreciated. Be that as it may, one of the great pleasures I have on the show is to bring new and interesting people to the show. We have probably 100, 150 guests that we've had on over the last 3-5 years. The show's been on air. And this is a new person who is new to both of this show, and I believe, I don't know, her name is Monique Chevalier from Arch Home Loans. Really appreciate coming on the show. And what I was thinking, Monique, is are you new to Arch as well, or have you been there for a while?
I've been there about 90 days.
I see. Very good. Tell us why you went there. I know that you've been in the business a long time. You've been on the broker side, maybe in the lending side, and now you're on the account executive side. What drew you to them, and how come you're on that side of the aisle now as opposed to on the retail or sales side?
I left the retail side when I had children that went to junior high school and there was no more daycare.
I see. Of course,
So
that made sense, yeah.
But about 20 years now. And what drew me to ARC was that they don't have a pass-through that they put the loans through. We are the actual lender. So we write our own guidelines, we make our own exceptions, and we are the bottom line. It makes for a smooth transaction for the borrower.
Absolutely. So that means you're portfolioing them, or you have a single or two investors like your type of loans?
We have our own single investor that lets us write our own guidelines and purchases our loans.
Excellent. Tell us about your programs, please.
So we have the alternative lending products for someone who is self-employed or 1099. We do 12 and 24-month bank statements. So where they would traditionally write off their income on their tax returns, we take the deposits and we give them up to 20%, up to 80% of the deposits, and we use that as income to qualify. And I can do a loan up to $3 million on that product. And then I also do a loan for investors where just the rent has to cover the payment on the mortgage. And if the rent does cover the payment, then I do not need any income documentation whatsoever. And then I also do full doc loans that are jumbo up to $3.5 million. And I also do ITN loans and foreign national loans on these products as well.
This is a true non-QM product list that you're giving me, right?
Correct, yes.
And are you, obviously you've got to be pretty excited. This is an underserved market for the last 6 or 7 months now.
Correct, yes. I was very excited to get back to work. I was very excited every time they rolled out a new product, and I can't wait for the loans to roll in on it from you guys.
Exactly. Okay. Your own personal experience with loan officers. Now, I know loan officers are not a cohesive unit, but they do act a lot of the same way. Professionally speaking, what would you say is the main, I guess, or the biggest obstacle you have towards working with loan officers, i.e., let's say I'm a borrower and I'm trying to get a loan and I have to go through my loan officer, and the loan officer says I got to talk to the account executive who talks to the underwriter. In order to smooth the process over, what's the obstacle that you have to get a loan officer to understand, especially in the non-QM specs section?
I feel like we have a more savvy loan officer post-2008 because I feel like the most serious people are still in the business.
Right.
As far as obstacles with a loan officer and non-QM, it took a long time for people to understand that this market was not what caused the market to crash in
Right.
2008. So that was my biggest obstacle. Now, moving forward, what I run into with loan officers really is more in the younger set of loan officers that don't fully understand the difference between qualifying in this untraditional way versus the traditional way. But that's where someone like myself comes in very handy because I've done both and I can walk them through it.
Yeah, I agree with that 100%. And having a long-term or a perspective on the way it was prior to 2008, through the 2008, the Dodd-Frank, all the way up until today, you can really appreciate the difference between what they used to call subprime and what non-QM is. The ability to repay rule is really the thing that is still, I guess, the one aspect that you have to prove on any loan. What are the challenges to prove that in your particular case, working with these types of loans?
The only time I run into a challenge with that is when I get a full doc loan that does get a DU approved eligible, but for some reason it doesn't fit the DU. So it's just proving that the reason why it cannot go on a Fannie or Freddie loan, that's the obstacle there. And it's usually only on something that fits in that smaller conforming loan amount, which we don't run into a ton in California anymore.
Right. How are you all handling the forbearance issues? If you have a loan and it's newly minted, or you have one that's been in a year and someone goes into forbearance, how is that affecting your particular or your ability to continue to do business? Obviously, you can't have that sitting on your books or have that come back to haunt. How is that affecting, or do you have many of those loans?
I actually only have one, and the borrower was offered a forbearance, and so he said yes, and then he got the paperwork and did not care for the terms of it, so he went ahead and made his payment and subsequent payments, but it's reporting as a forbearance on his credit. So in that situation, we're documenting around it. But as far as if there were any true forbearance, we're defaulting to the Fannie Freddie rule on that and just following their guidance on it. And I've only just done into the one so far.
Where do you think that guidance is going to go? I mean, we're looking at the end of December as to when this forbearance period is supposed to be over. We think we're going to get an extension, or are we looking at some other solution? What are you saying there at Arch?
Well, we're just going to default to them and follow them because we feel like they'll make a sane decision, if you will, about it. And, that's all I know at this point.
Yeah, I know. I mean, as a prognosticator, which I'm not, and also in the lending business, which I am, it's very difficult to see what's coming around the corner. But look, we're almost in October, and we have a national election, and obviously there are a number of different issues in the West, whether it's fires or hurricanes in the East. So people's minds are on a lot of different things. We still have 3.5 million people in forbearance. What's going to happen when the due date hits? That's what I'm trying to nail down, and obviously I'm not having much success. Sounds like you guys also are trying to figure it out.
Trying to figure it out, and obviously with our hearts, keeping those people in mind in our hearts,
Of course. I mean, this is all about people, right? People who have to stay in their house. What are you going to do? Kick them out? What's going to happen when the rent moratorium ends, when people have to pay their rent? It's already affecting, 20, 30 million people one way or the other. It's a mess. I like the fact that non-QM, your company, is strong because it gives people a different alternative in order to obviously afford their house.
Yes. Yeah.
So do you see any introduction of new products in the market in the coming months?
We actually just introduced out the foreign national and the ITN product, which is super popular in Florida, as you can imagine. They get a lot of immigrants there. But those are our latest launch of products. I think the next rollout that will come out will be one that allows for rates on a mortgage or on rent and that type of thing, like we did have pre-COVID. But at this time, no one is loaning on that. So I think our next launch will be that, and I think it will be a January-ish launch.
Monique, thank you very much for coming on the show. I really appreciate it. And if you could please shout out a phone number for people to get in touch with you if they want some answers to some great products you're talking about.
Absolutely. 949-244-0812. And thank you very much for having me.
Thank you very much again for coming on the show. Monique Chevalier from Arch Home Loans. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks very much for tuning in. We're on a number of different radio stations as well as on all of the major podcasts. Daryl, you have those lists of the podcasts we're on?
I sure do. We're on Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and YouTube.
Great. And as a result of being on those things through our affiliation with KCAA, one of the great radio stations that we've been on for, it's got to be 5 or 6 years now, out in the Inland Empire of Southern California, we're able to reach more and more people. And each and every week I get comments either from the radio show or YouTube, Jeff Barton at the Mortgage Voice, or from our Zoom, our LinkedIn or Facebook shows, which each and every day. They're kind of quick updates, no more than 5 minutes, and appreciate it. If you do hear and see anything that you like, or you want to make a comment, please, when you go to any of these number of places that you can see or hear the show, click that you like it or you don't like it, or join, or anything you can do to help us promote what we're trying to do, which is to bring mortgage information, real estate information to everybody. I had a friend who we do a lot of video with out in Las Vegas, not this year, but we have in the past, tell me, he said, look, you may think that it's rudimentary and that everybody knows what you're talking about. The reality is, not everybody knows what you're talking about. You're 30 years in the business, and so therefore, what you think is mundane and a walk in the park is really useful information for people who just don't know enough. And in the financial world, mortgages are made more complex than they really should be. It's because of what they call the underwriting process. How do you get approved for your loan today? What is it exactly that makes you different than your next door neighbor? And how come, based on either the loan amounts, your credit score, or other factors, how come there's so much difference in what kind of loan each of you get? Well, as a loan officer, as a mortgage broker, as a mortgage lender, all these hats that I wear gives me a perspective that says you're unique. You're not different or special, but you are unique in that what you need in your mortgage is different than somebody else needs in their mortgage. There are what they call cookie cutter type loans. If you have a W-2 paycheck, many millions of people do. If you have a certain percentage you can put down on a mortgage if you want to purchase, or equity in your house if you want to refi. That's part of the cookie cutter formula. If you have a terrific credit score, and what I mean by terrific credit score, above 720. If all these factors and you're a cookie cutter loan, that means any number of major U.S. banks, Bank of America, Wells Fargo, Chase, Citi, all of these institutions can give you great rates. If you have your checking account with them, or if you have wealth management with one of them, they can even give you a better deal. However, if you're not that type of loan, and I do say that there's still a unique borrower, but let's say you're outside that particular, parameters or profile, or what they call a unique client. What we want to be able to do is to find you either a mortgage that's not necessarily traditional, or something which is below 720 FICO score, maybe only 10% down in terms of your purchase. Maybe that you have a W-2, but you also have some part-time income from your own personal business. There are a lot of different ways that we can identify a customer, their needs, and how we're going to be able to help them get a loan. I would say if you're looking for the type of loan where you're a self-employed borrower, meaning you have your own business, you have a little grocery store, you have a delivery business, you have a floral shop, you have a real estate company, for instance. You can all work for yourself, and those bank statements from the business can help you get a loan. Being that there are a lot of different solutions out there, we want to make sure that you're covered and that you're comfortable with what you see. Now, anytime you go and you look for a loan officer, a bank, or a lender, you have to be very comfortable with the person you're talking with and dealing with. And since most of the interactions in any of these loans are now done either electronically, telephone, there's very few face-to-faces. Even if you go to your local big box bank down at the corner, Chase, Wells, they're gonna take your application. It's gonna disappear into the underwriting processes of the bank, and you won't ever talk to those people. You only talk to your front person at the local branch, and usually they don't have the power to tell you yay or nay on the loan. It takes time. What you want to do is make sure that you're with somebody that you trust, that you're with somebody that you can give your personal information to, and that's very, very important to what you need to do in order to get a loan. So make sure that that's part of your process, finding that person, interviewing that person. Now, we all don't have time. I mean, even in COVID, nobody has time. Why? Because you're easily filling up your day. And one of the things, Daryl, I wanted to ask you, during COVID, right, you get busy even though you can't leave home. Am I right?
Absolutely. And, you just don't know who to believe and who to trust about how long someone may be contagious. When you go here, everybody says, "Oh yeah, I had it before. I'm okay now." Well, how do you know? Are you sure?
Right.
What's the checklist? What's the criteria? Have you been back and tested? No. So testing is really the best method.
No, in terms of the COVID, there's no questions. You've got to be tested. You've got to let people know where you are and what you're doing. I think being at home a lot, I have occasion now to go into the office, but when I go in there, there's nobody there anymore. So I see nobody. I bring a little brown bag for lunch and I eat and I get back in the car and I come home. But if you're out there in the world and you're like now coming home, it's got to be a difficult situation. Now, for COVID, you yourself are dealing with that at home. I hope everything there is fine.
Much better, thank you.
Oh, good, excellent. Okay.
But you're right. People now, don't seem to feel like they need to have an outside, brick and mortar place to go. A lot of people are doing business from their home and nowhere else. I mean, they're building offices and panic rooms and all kinds of crazy stuff into these houses these days.
Yeah, no, all of that's true. And there's an article here on the Mortgage Professional Association of America that talked about how much of a bite will remote work take out of future demand for office space. That's kind of what we're talking about. There's a safety issue. Certainly now during COVID, I mean, I would say, 40% of the employee relationship and workflow is done from home. In Malibu Funding, the company that I happen to work for, most of the people that work for Malibu Funding, I would say 98% work from home. There is an office staff that does accounting and bills and the logistical stuff, but even that can be done from home. I know the administrator for the company works from home. I work from home 4 days a week. So that particular issue is, so what's going to happen to the office space? What's going to happen to people who are used to going or like going to the office because they like the separation? The article mentions that there are a couple people that believe that it's not going to be a big factor, that once COVID is over, that people will go back to the office. I'm not quite sure that that's true. I don't know enough about it since it's never really happened before. I don't know. What's your feeling on that?
Well, I think it's a learning process. I think a lot of companies realize that they may not need as many people on site as they thought they did because of the working from home. And I think that they're also going to find out they may not need as many people as they thought they did. And when it comes time to invite people back, I don't think everybody's going to be invited back to come back and work, because it's an opportunity for employers to really sort of separate the wheat from the chaff, where they had to have a bunch of worthwhile reasons to get rid of somebody before that. Now with this, they can just sort of leave the people in the dust that they don't like.
I agree. And I think people who are pushed off are the low-end worker, the older worker, the unskilled worker. Anybody who works for a company knows exactly what I'm talking about. And you can see from the people that are kept to the people that aren't kept, the value that they hold for a position, maybe not necessarily a person. And it's universal. So I don't know what happens with the downtown office space, the larger offices that used to house 100, 200 people. Do you really need that anymore? And what's going to happen with that particular space and to the price of the spaces currently in the building? I don't think any lease has dealt with that. And if you're a company that right now looking to downsize, I think you need to get legal involved, your legal department, or call up an attorney and ask them, because of the fact that this has been a huge pandemic, can you get out of your lease or renegotiate your lease without fear of the landlord coming after you? And, you know, the landlord, look, they're not bad people. They went into a business. This is what they do. They have to reinvent the space. And that's exactly what the guy in the article is saying. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.